So to think that people are going to, it's like, when you think about the actual utility of lending, it is, a house being collateral for a loan, or a car being a collateral for a loan, or a plant being a collateral for a loan, that people post hard assets and get that because what they need is money. So the corollary would be like if there were like Bitcoin denominated
Well,
loans.
I would distinguish the two. Not necessarily they need money, but they need liquidity. Because a lot of people have enough money, but they want money.
Well,
like you could have.
Well, but liquidity
I would
is
say liquidity
money.
is what more so.
But I would say liquidity, like money is liquidity. Like they're the same thing. But anyways, I wanted to say something about it's like you go to money because you need you need liquidity.
Gold is money, and gold for the most part is not liquid. If you have physical gold, gold is money. It's not liquid at all.
Right. I agree. That's why I'm saying that they need dollars, a more liquid asset than gold. That's what somebody's posting their treasuries to get so that like the idea that like the treasury is the collateral of the U.S. financial system.
It's debt on top of debt. But I would as someone giving someone a loan, I would rather have them give me Bitcoin as their collateral than them give me treasuries or them give me gold bars or them give.
No, I understand. I agree with you. It's like I think that Bitcoin is better collateral, but it's also the money. So it's like it's like if everyone's borrowing against their Bitcoin, but Bitcoin's money, like at what point when everyone is storing their wealth in Bitcoin because it's the best quote collateral, where's all this other money that no one wants to store their value in being, who's demanding that? That's the thing that confuses people about this idea that Bitcoin is always going to be at rest and be the collateral, but never be spent. And if you disassociate it with money, that you actually do more, in my mind, you do more harm than good, because it's like, wait, are we all, what are we actually doing here? Are we all staring at the digital bits on our computer screen? Is it possible for that to create value? And in reality, the way that Bitcoin creates value is as money, is in the transfer of value, whether Strategy has to sell 32 Bitcoin to pay a dividend or 3,500 Bitcoin to pay a dividend. It's functionally no different than if, somebody pays Simple Mining for power in Bitcoin. It's a value transfer for a Bitcoin. And that where I think that, one of the things that you mentioned that I would probably disagree with the most is that, when people say that they're creating financial products that, or, in the case of Bitcoin treasury companies, to allow people to be exposed to Bitcoin that otherwise wouldn't be able to. And I think that is a good soundbite. And I'm not saying it's your soundbite, because it's the soundbite that the Bitcoin treasury companies push, is that anybody who could invest in Strategy could invest in or Strive or any of these others could invest in the ETF. The difference between Strategy and Strive and the ETF is that there's a way to actually get the Bitcoin without a tax event, right? And this is something huge that no one talks about in the corporate, Bitcoin corporate treasury world, is that they have a double corporate tax, and how that is offset. If you were ever to get the Bitcoin, the corporation would be deemed a sale, and you'd pay corporate taxes, to get the Bitcoin. How are you going to outperform Bitcoin if you are starting with that handicap and the stock is trading at a premium? So it's like anybody that could invest in that stock could invest in the ETF. Then when they say that, this digital credit, it's like that in itself is, a marketing tactic. And what you said was they sold this as very low vol. Well, two things. One, Mass Mutual and New York Life both bought Bitcoin in 2020. Whenever somebody says that that these credit products need to exist, it's like they're acting as if two insurance companies that were founded like before or around the time of the Civil War, if they could buy Bitcoin, who are all these people that can't? And so it's like it's like a soundbite that sounds good, but it's simply not true. And then the other thing from a more practical perspective, and again, the way that a Mass Mutual, they bought it for their general account. They figured out a way to do it. Like at that time, they bought it as a fund of one because they technically had to own a security. Well, why would someone do that? Because somebody helped them understand Bitcoin. How do you mute volatility? A proper, like, own 1%. Where does the yield come from? Somebody else buying Bitcoin and not you. How do you manage volatility? Just buy enough so that you have diversification. But more realistically, institutional credit investors cannot buy perpetual preferred equity. Like, people struggle to understand how, companies that actually lend directly against Bitcoin. I'm not advocating that. I don't take Bitcoin back loans. I don't recommend them. I think that they're risky too. But that it is difficult to get somebody, trust me, as someone who's tried, to get someone to lend for 1 year from actual like credit fund perspective, because they have like typical closed end life of their funds, and to think that you could get someone to lend to you forever, it's like that's a retail product. It's a retail product, and retail could just buy a smaller percentage of Bitcoin. Institutional credit cannot invest in something that doesn't have a maturity. It's not credit, it's perpetual equity. And then the last thing I'll say, and I'll turn it back over to you, is that that it will, the reason why you brought up yes, it was sold as volatile, or sorry, as not volatile. It was sold as not volatile. It was sold as a replacement for cash. It was sold as a money market. Part of what got me, a little bit fired up about this was that I learned a friend of mine had bought one of these things with leverage. So when I was like, well, you just buy a smaller percentage of Bitcoin, you'll get the yield. He's like, well, it's actually 19% because I'm levered on Robinhood. And when you start to sell things as low to no volatility, and if you think about like these preferred equities, last things, they will always be volatile. They might not be as volatile as Bitcoin until the end, and they'll be volatile on the reverse side, but they will always be volatile around Bitcoin's volatility because they are products that naturally appeal to Bitcoiners. So when Bitcoin drops from 80,000 to 60,000, what do you do if you own that and you're a Bitcoiner? Well, you sell it to go buy Bitcoin because Bitcoin now has a much lower price. It's on sale. The risk-adjusted return, or the weighted upside versus downside, has just gotten better. That you're not stripping out Bitcoin's volatility. It's always going to be levered to Bitcoin's volatility, and there's no long-term holder base for them, because whoever is left holding that bag is going to zero in Bitcoin terms and in fiat, because there's no maturity. Like when fiat hits up, like when it hyperinflates, or when inflation gets real aggressive, the market is going to sell that to get whatever amount of Bitcoin they can. So I'm like, you have to be willing to create bag holders, sell it in a way that is misrepresentative, that it's not volatile, and that it's credit, when there's a reason why credit investors cannot buy it. Why not just help people understand Bitcoin? Why not just educate people on why they would want to own Bitcoin? That's what I don't get. But I get why the products are bad. I'll turn it back over.
I think something interesting I saw you said, and again, I'm generally newer to the Bitcoin space. I've been working here about 9 months now. I think for me, the main thing that I always thought was a positive of all the institutions is just general adoption, and just improving Bitcoin adoption, which I think is ultimately what probably is holding up Bitcoin's price more than anything. But I think
I disagree with that.
Really? Interesting. Okay. I guess I'd be interested to hear as to why.
Well, because anybody that buys the stock would be a logical person to buy Bitcoin, and they're realistically just getting less Bitcoin than they could have bought on the open market, because the stocks are trading at premiums to the net asset.
Yeah, but even would you say the same for like IBIT?
Well, no. So IBIT is different because two things. IBIT is managed to NAV, so you're more directly participating in a passive way. Like when you buy Bitcoin, they buy, and then one of my other issues, the reasons why I don't have an issue with Bybit is like, hey, everyone who's buying the stocks, they're pricing the stock, they're not pricing Bitcoin. So it's like, the flows for the ETF are people that would be buying Bitcoin or selling Bitcoin, but then the flows for the Bitcoin treasury companies are the same. It's just, I would say that the Bitcoin treasuries are targeting people that have a deeper understanding of Bitcoin, because they are the ones that are selling, we will get you more Bitcoin, versus the ETF being a more passive flow.
Parker, I just want to make sure I'm following you correctly. You're saying institutional adoption is bad for overall Bitcoin adoption?
No, absolutely not. I'm saying that I might have misheard you, or maybe thought you were associating it with the Bitcoin treasury shareholder base. I don't think that the Bitcoin treasury companies are net adding to adoption. I think institutional adoption is great for Bitcoin. Like, Mass Mutual and New York Life buying Bitcoin in 2020, that's institutional adoption. Stone Ridge buying Bitcoin in 2020, that's institutional adoption. So I just don't think that the treasury companies are adding net Bitcoin adoption.
Yeah, but that's basic. If you break down what a treasury company, I think it's been skewed. There's like a company that has Bitcoin treasury on its balance sheet, like Tesla or SpaceX, for example. And then you have a company that arguably doesn't really have a underlying business model. You have like MicroStrategy. They came from their business intelligence software suite, and they still have some business there, but the majority of their market cap is built upon them just buying a bunch of Bitcoin and holding it.
Agree. But the people that buy the treasury companies could just buy Bitcoin. And what I'm saying is that
well, is that not what they're doing? They're buying Bitcoin and they're holding it on their balance sheet and probably holding it through some multi-sig.
Yeah. So I'm just saying that. I'm saying one thing is that they're not bringing net. Like,
what's demand? That's demand for. I guess like if we're looking at.
Well, I'm saying like if that company didn't exist, but the people were going to buy Bitcoin, they would have just bought Bitcoin. So net, at best case, it's neutral.
Wait,
is all I'm saying.
Well, what about this? So let's say you're you love Blue Origin. You love what they're doing. They're going to space. Great. You also love Bitcoin, but you ultimately are only allocating 10% of your funds towards risk assets. So the next obvious choice would be SpaceX, because part of their balance sheet is Bitcoin. So wouldn't that overall be a net positive?
Oh, I think it's great that, I don't put the SpaceX in the same bucket. I might be misinterpreting. And
well, let's think about just like strategy as an enterprise software company. So, or a good example is like Block. Block does their core business model is point of sale systems to restaurants, retail locations worldwide. So that's effectively a risk asset because they're doing 40% growth year over year. So by them also having Bitcoin in their balance sheet, you now have mutual adoption to both categories as an investor. So that would be a net positive towards adoption overall.
Yeah. No, I don't put Block in the same category as the Bitcoin treasury companies. Like Block has a infrastructure business that sells, that has cash flow, and they convert 80% of their gross margin generated from Bitcoin, or maybe it's 50%. They convert some percentage of their gross margin generated by their Bitcoin products, and they keep it in Bitcoin. Yeah.
I think I also misunderstood.
But also, like, I'm not saying don't invest, right? I'm saying like, hey, I have a company that does Bitcoin payments. You guys Bitcoin mining, love it. I am advising a friend on a Bitcoin mining project. Like, risk will be taken. Like, opportunities to make more Bitcoin exist. I'm saying if you're going to give your money to a company that all it's going to do is buy Bitcoin for you, you are almost certainly going to get less Bitcoin, and that business is not adding net incremental demand.
Would you say that that's like,
okay? That's a fair take.
Yeah, but would you say that they're not just buying Bitcoin and telling people, like investors, hey, give us Bitcoin and we'll buy Bitcoin for you? The selling point is that like strategy is able to access billions of dollars from the equity market that most companies cannot do that, and they're able to create financial products that obviously there's demand for them. People find them interesting, and that's basically what their business is creating financial products that have unique volatility and unique risk relative to Bitcoin, and selling those to investors. And it's obviously working. Like they've 10x their market cap. They've over 10x their market cap.
Sure. Well, but the amount of money that, so like you let's pick an example. From 2024 to 2026, Strategies raised $40 billion of common equity. Those investors that bought Strategy have underperformed Bitcoin. Okay, they could have just bought Bitcoin.
Yeah, but you could cherry pick any window. You could also
but it's 90% of the equity capital that they've ever raised in their history, and there's a reason, because the stock was trading at a premium to the actual amount of Bitcoin. So people were buying in to a stock that was trading at 2 times the amount of Bitcoin they held to go buy Bitcoin.
Yeah, I'm sure you could see
so my point is like the fundamentals of risk. If you ever look at a company that only has cash on its balance sheet, that company will trade at a discount to its cash. Why? Because it's not your cash, it's the company's cash. You're not in control of it. Time value of money. And then if we layer on risk to that, it's like, hey, you can buy the identical underlying asset, Bitcoin. And whether you buy that, use a custodian or self-custody, if you are paying a premium, if the market cap is trading at a premium to the actual amount of Bitcoin it holds on a net basis, what you are functionally doing is saying, I'm going to pay a premium to take risk, which is the opposite of the way that risk is priced. It's like, hey, if you're going to take risk to have incremental upside, that you need to receive a risk premium, not pay a premium to take risk. And if you go back and look at some of the early comments from Saylor about risk premiums, and that your stock will only hold value if you can outpace the.
Isn't that what you're getting through the dividend? Like they're essentially.
What's that?
Isn't that what you're getting? Like in Stretch specifically, that's basically like the cost of capital would be whatever the dividend they're paying, call it 12%. That's what the market is demanding for the risks associated with buying Stretch. And that's the premium.
Well, right before I was talking about MicroStrategy, but Stretch is a dollar-denominated preferred equity security. So, my view of that is that the last people to hold that, when fiat hyperinflates, it's going to go both to zero in Bitcoin terms and in fiat terms, because
it sounds like your underlying thesis to all of this is that within the next, call it 40 years, the dollar does not exist.
That is my view.
There's a few underlying things.
Yeah, but even if that isn't my view, you're still better off just buying Bitcoin, right? Because if these companies trade at a premium, and 2, if you have to pay corporate taxes at the corporate double taxes, no one talks about that. No one talks about the fact that there's risk associated. No one talks about when they throw their large scenario of how the leverage is going to work in their favor. No one ever talks about the implications of corporate tax versus just holding Bitcoin directly yourself. No one talks about risk premium, and no one talks about how they're discounting those future scenarios.
Even if you just evaluated in Bitcoin terms, let's just look at it from like, if you buy a share of MicroStrategy today, you're getting the equivalent of what? 0.0001 Bitcoin. And then if Strategy is able to effectively do what they're trying to do, then you can hodl that one share for the next, 2, 3, going to the Bitcoin associated with that share is going to be 0.00012 Bitcoin instead of just 1. So if you're able
but the thing that you have to compare against is, well, how much Bitcoin could you have bought today?
Yeah, but that's what I'm doing. Like, if they could have bought the same amount of Bitcoin, when you buy Bitcoin, you can't be accretive in Bitcoin terms unless like you somehow are getting a Bitcoin dividend on your Bitcoin, which doesn't make any sense. But if you're buying a share that has a certain Bitcoin value associated with it, and you're able to be accretive in Bitcoin terms, meaning that share is associated with, which it's not convertible, like you can't convert your share into Bitcoin. But if that Bitcoin associated with that share is more in the future, then that would be why you would get an amplified.
Yeah, but and I'm just saying that the likelihood that you actually get more Bitcoin is so low because the shares are trading at a premium, which is the backwards risk skew. They're trading at a premium to the amount of Bitcoin that they hold. There is risk associated in how that actually plays out, which is predicated on finding more bag holders to buy the dollar-denominated preferred equity for which institutional credit markets.
Yeah, but they deserve those bag holders. Who deserves
the bag holders?
I understand what you're saying, where it's like, okay, you could come here and buy one Bitcoin, or you could buy one share of MicroStrategy. It's like a really
which
fair
would be
comparison.
the equivalent of like buying this time would be the equivalent of buying like 0.96 Bitcoin.
I would say buy Bitcoin every single time, but you're leaving out some of the other adoption elements. Like every single 401k in the world can't buy Bitcoin straight up, and
but they
more
can
than
buy
likely,
the Bitcoin ETF.
Well, no, you actually. Most 401ks in America allow for ETF buying, but they cap it at a certain percentage, whether it's 5%, 10%, or 15%. At a max, the number one contributor in the world, Empower, that allows for it, only allows 98% of your contribution. Still not 100%. So if companies like
they allow
Treasury
to,
companies,
have.
Well, if they get into like the S&P 500 index fund, now every single 401k program and every single investor in the world can now buy Bitcoin through the S&P 500. So overall, that would, skyrocket it and quote unquote get those bag holders.
So one, I don't understand why you want to create bag holders, because again, the whole idea that you would get more Bitcoin this way than with the ETF, or again, no one. If you could at least like recognize the consequence of corporate taxes in this equation. Right? Like assume fiat goes to 0 or declines 99%, and you're looking at something on a Bitcoin denominated basis, and you like take 20% off of
corporate tax is only relevant if they have to sell their Bitcoin.
No, but if you right, isn't the purpose of businesses to return shareholder value?
Yeah, which the purpose of a strategy or a meta planet would be to increase the amount of Bitcoin they have on their balance sheet relative to the outstanding shares.
But someone's investment in a company,
which is evaluating a value accretion in Bitcoin terms,
would be predicated on return of value to shareholders.
What is value? Are we evaluating Bitcoin as value, or are we evaluating dollar price per share?
We're talking about the key part of this is return, an actual return of capital. Right. So it's like if you never sell the Bitcoin, if you never dividend any money to your shareholders, then what is the purpose of the business? Right. It's literally just, zeros and ones on a screen. That the basis of investing in companies, like, if someone was investing in Simple Mining from an equity standpoint, they would never make that investment if they were never going to get value back in return. Like actually receive the value and buy a car or buy a house or do whatever if you did all the things to create the value that you set out to do. And so my point is, if anybody was actually sitting down and valuing the stock the way that any stock is traditionally evaluated, they would, like, even if you at the end of the 10 years of whatever you assume leverage they're going to be able to take, you would have to apply the corporate tax rate, because in a theoretical world of businesses exist to return value to shareholders, you have to contemplate it in the analysis. Otherwise,
they'll never have to sell their Bitcoin. They just did.
Will they never return capital to shareholders?
Why would they need to? Because the whole arbitrage play is that
why would you invest in a company if you didn't expect them to ever return value to you?
Well, you could get your money back by selling the share, and that has nothing to do with return on capital.
Yes, you can sell your shares in the secondary market. Like the whole existence of a Bitcoin of a business is to and to have shareholders is to actually return value to them. And I know that we've existed
in the same thing. Go back to the same thing in Bitcoin terms or in dollar terms, because if they're trying to,
well, I'm talking about in Bitcoin terms, but
even in Bitcoin terms, that's what they're trying to do. Which I'm not like a mega bull. Strategy.
I don't think you're understanding what I'm saying. It's like even if someone did take set aside Bitcoin for a second. If somebody took Google for an example, and Google, Google's a bad example because they actually pay a dividend, but pick a company that doesn't have a dividend, that doesn't sell their assets. if any Wall Street analyst is valuing the companies, even though they're not returning capital to shareholders, they apply a discount rate and a tax rate on future expected earnings as to how they value the capital. So if you're assuming like, hey, MicroStrategy has 840,000 Bitcoin and they're going to grow that to 1 million Bitcoin, and it's like, what is that worth to me as a shareholder, or what would someone else be willing to pay? Well, if they were to ever return the capital to the shareholders after fiat has gone to zero, maybe they don't, but you still have to contemplate that because that's your reason for holding it. Otherwise, you realize literally zero value as a shareholder base. You have to contemplate taxes. Like that's not controversial. Like if you ask Michael Saylor that, he might say, well, we never plan to sell our Bitcoin. But if you were evaluating the value of the stock to a shareholder, if the aggregate of shareholder, if all you were going to get was, introducing another shareholder, then they themselves would be slotted into your predicament. So I'm not talking, I know that you can like sell stock and, then realize their capital gains, but I'm talking about like the idea that there's double taxations of corporates.
Yeah, but I just don't understand how strategy is going to have to pay. Like, if shareholders should be concerned with the double taxation.
It's not that they're going to have to. Well, if they ever dividended, okay, if there was ever return of capital to shareholders, which would be the in theory reason to do this to get more Bitcoin.
Well, that's not though. Like if I guess depending on the instrument.
If you guys aren't thinking about this, like I would implore you to like think deeper on this one.
I think that, and like depending on the instrument, I would say at least the way that it's been communicated for Mike, like
the way that the preferred was communicated was that it was low to no vol. And there's a real fundamental reason why it will always be volatile and why the last person to hold that is going to get virtually, wrecked.
Yeah, I mean, I think that like from the yes, there was some miscommunication, particularly on how Stretch was marketed. But I would say from the perspective of somebody just holding the base equity, the kind of the bottom of the stack, the MicroStrategy, their concern would not be related to the double taxation, because I would say MicroStrategy's goal is to eventually become like a bank where they're able to lend money and they have their massive million Bitcoin they have on their balance sheet as the collateral. They're not planning on selling that. They're going to be lending against it for pretty much everything.
Yeah, and I'm saying even in that scenario, you'd have to contemplate the consequences of the double tax to ascribe a value to yourself or how you would price the stock, and that just doesn't that like.
Yeah, but it's like you don't price Bitcoin off of when you're
because it's money.
Have to sell it and pay taxes on it.
Well, but also all I'm saying is that it's money, and you don't have everyone would have capital gains tax, but if you're just holding Bitcoin, you don't have to have the effect of double corporate taxation. Like, and again, the thing that makes this unique is that if you want to buy, into Google's cash flows and own a share of Google's assets, there's one way to do it. You have to own Google stock. The thing that is,
and if you want to own MicroStrategy and all the preferred credits they're offering, you have to own MicroStrategy.
Well, if you want to own, if you want to own their common equity, yes, but their underlying asset, their whole reason for existence is buying Bitcoin. So it's like in this case, their underlying asset, like you cannot buy Google's underlying assets in any share of that outside of the stock. You can buy MicroStrategy's underlying asset, which is Bitcoin, directly with far less risk and without the consequence of.
I guess. Does this mean you ultimately think strategy will fail?
No, I think that strategy will materially underperform Bitcoin, and that all the people that are buying the stock.
Well, that means they will fail, because if they underperform Bitcoin, they eventually will fail, because their hurdle rate is. I guess their hurdle rate is the 12% or whatever their dividend is.
Right, and it's in the lion's share of it. And again, I hope this isn't confused. I don't think the strategy is going to fail. I just think you and you are all, everybody here is going to be better off if they just bought Bitcoin. certainly the people who are buying the preferreds are going to be worse off. But the strategy doesn't have to fail because it's actually smart, right? Like 6.7 billion of the is convertible debt, and 15 billion is perpetual preferreds that have no maturity. So strategy stock can go up in fiat terms while you can also get less Bitcoin. And that's all I'm saying. And that's actually not the problem that I have. The problem that I have is when people start confusing people about the nature of Bitcoin as a means.
What if we're in the year 2140 and there's no more Bitcoin to be mined and MicroStrategy owns 1 million of it?
Well, how much could you have had though if you had bought them in 2026?
Oh, no. Listen, I understand the benefit.
I know that you can't buy 1 million, but I'm just saying, however much capital you would have invested in MicroStrategy, I am confident that you would have more Bitcoin.
The point I'm talking about is you were mentioning how they're like the fundamental duty of any company is to provide dividends or returns to an investor, right? So
yeah,
that theory can still hold true in 2140. Like, effectively, if you're building 100-year companies, right? That's GameStop CEO Ryan Cohen. He goes, I don't care about like these retail investors. I'm building companies that are meant to be centuries years old. So effectively, that theory can still hold.
Yeah,
do you agree with that?
Yeah, I agree with that. Like now, as a function of scale, right? When you already have 140,000 Bitcoin and you're dealing with the consequence of all the risk association with censorship, and all the risks that go along, I should say, is like the risk is mispriced. And if you're getting if you're investing on this idea that at some point in the future all the capital is going to be put at risk in loans and some risky behavior, again, you got to in theory you would discount the price today. And then the other side is I'm saying the company is literally doing this. I'm literally telling people to do exactly what the company is doing, which is selling their stock to buy Bitcoin, or not buying their stock to then hold cash. Right? You could just buy the Bitcoin. It's not particularly controversial, and I don't even have. I mean, the biggest problem that I have with it is shepherding people into these preferreds that are going to ultimately be very bad products for them. But even that, I get past. It's like when you have to start confusing people about the nature of Bitcoin to make your stock make sense, or to sell your stock, or to sell the preferred stock. It's like that's what I actually take issue with. Again, all of this stuff was going on for a long time, and I never said anything. And then when I saw, we turn Bitcoin into money, it's like I can just tell you from the number of people I've talked to about how confused. It's like, what do you mean? If it's like, what is Bitcoin if it's not money? Oh, it's capital. What do you mean by capital? Like, because it's not capital in like the, capital good sense. Like.
I think they're just providing the perfect bridge for like old school. I got off a phone call today. So like one of the things that I'm working on that, if you're a simple mining customer will be offered probably like a week from now is effectively 0% down. And you can purchase a miner up to effectively like $1 million or $2 million. When I was doing the underwriting with the banks, they effectively value Bitcoin and future Bitcoin mining revenues at 0. But a MicroStrategy or a Treasury company that's trading on the New York Stock Exchange has a bit more credibility to it than just like Bitcoin. So if they're bridging that gap, I say Bitcoin is money. I feel like there's a lot of value.
I'm saying they're not bridging the gap as Bitcoin money. They're confusing people by expressly not describing it as money. They're calling it digital capital, and then we turn Bitcoin into money. Well, if you turn Bitcoin into money, what is Bitcoin? And then also it's like the banks aren't the ones lending to strategy, because a bank wouldn't invest in, like, there's a reason why large pools of capital would not buy perpetual preferred equity, particularly not lenders.
Well, doesn't that beg the question? If you say Bitcoin is money, and then you say, well, what is Bitcoin? Well, Bitcoin is just money, right? Doesn't it beg that next follow-up question of,
I think there are two separate.
What do you mean by that?
You're saying Bitcoin is money.
They don't say Bitcoin is money. They say Bitcoin. They say we turn Bitcoin into money. They say Bitcoin is digital capital. Like,
I mean, I've listened, like I've been listening to Saylor ever since the Saylor series, and I know without a doubt that Saylor has a better in-depth understanding of what Bitcoin is and what Bitcoin means as money, as energy, as a technology, as an engineering solution, as a philosophical solution, as an economical solution. He has a better understanding of Bitcoin than 99.9% of people. And whatever the marketing lingo, like I get, like, the digital credit thing is ridiculous. Like, it's basically just credit. Like, it's all this kind of like fancy wording that's framed around the stuff that they're doing. And I think they're trying to just have like their own nomenclature and their own naming convention, like name it and claim it. Like, they're trying to own this niche that has never existed before. And so, and it's obviously causing a lot of miscommunication. People thought that stretch was supposed to be stuck at 100 and now it's not. And like,
but it never was going to be. And I can explain the fundamental for why that is, but they sold it that way, knowing it.
Yeah. I mean, I also don't think that they ever said it would never go below $100. Like, I think it was, at least I understood that if it goes down, meaning there were more sellers of stretch than buyers, then they would just raise the dividend to incentivize there to basically balance that out, for there to be more buyers of stretch than sellers of stretch, to move it back to 100, to whatever basically it was letting the free market set what is the cost of capital for you to give us money to buy Bitcoin. And it's 12%. Oh, well, that's a profitable business for us because we can basically pay you 12% and go buy Bitcoin for a 30% ARR for the next 20 years, is like the stuff that they said. And so I think that, like, from that perspective, it makes sense what they're doing. And I wouldn't say that it's necessarily going to fail because they have 800,000 Bitcoin. And like, when you're buying, what?
I didn't say that it was going to fail. I said you're better off buying Bitcoin yourself.
Yeah, and I think that, like, I would generally agree with that. Like, as from a like percentage of your wealth, I would not say that more of it should be tied in a corporate wrapper of strategy than you holding self-custody Bitcoin. I would 100% agree with that. But I also can understand why there's a place in the market for what they're doing. And I wouldn't be ignorant to thinking that, like, their products are stupid and they shouldn't exist and they're going to fail. Like, there's obviously demand for it. There's obviously institutions buying it. There's publicly traded companies that have millions of dollars of stretch on their balance sheet, and all of the other preferred equity that they have.
Based on what I've seen, 85 to 90% of the preferreds is retail. Logically.
Parker, if you had to go with three scenarios: one, these treasury companies cease to exist; two, we have the status quo, the treasury that exists today will exist tomorrow; or three, we have an increase of treasury companies over time. What's your idea scenario?
We will have fewer treasury companies, and the way I see it playing out is that these treasury, as shareholders figure out what I'm saying here, as they've been figuring out for the last 2 years, the premium will flip to a discount because shareholders will sell to buy Bitcoin, or other people will look at the equation and just buy Bitcoin, and the price of Bitcoin will go up and the price of the stock will lag. And the companies on an absolute basis will do very well. Their stock will trade at a steep discount to Bitcoin. They'll be able to cover all of their liabilities, but people will figure out that, if your company only exists or your strategy is just to buy Bitcoin, that, that doesn't work as a market because Bitcoin's money and you can own the underlying asset. And those companies, at least strategy, I'd expect, continues to exist. It's going to hold its Bitcoin, but Bitcoin trades at a premium to it. It can't continue to raise the preferreds and the common equity, and they ultimately change their.
What about when MicroStrategy was getting 0% notes? Isn't there a lot of value there?
And I look at it and I'm like, that again. I don't. It was more like truly capital that was not otherwise going to come into Bitcoin because it was convertible notes. Now, one of the reasons why they shifted away from that, I think those markets themselves got tapped. Strategy was a large percentage of that underlying market, and all those funds have like any credit fund has a concentration threshold that they can't exceed. And so like when it was just that, it was like, okay, yeah, it made more sense. Now when you're and again, I was totally asleep at the wheel, like, $40 billion of common equity that was raised between 2024 and 2026, or 2024 and 2025, really. I'm not even including what's been, the last like 3 months or so. That's a lot of money of people that paid a premium to buy a stock that was trading at a premium to the underlying asset Bitcoin. They could have just bought Bitcoin. Have learned a hard lesson, and the market generally, the market's always inefficient. The market becomes efficient as a function of time, and that's what I expect to happen. I don't think anybody needs to fail for that too, but I think that the market will learn, and they will learn that, they should have just bought Bitcoin. And, the way I think about it is a lot of people are YOLOing 5 to 10% of their money, but, if they look back as a function of time, well, 5 to 10% of what they could have had in Bitcoin is a lot.
Are you just also skewing it towards it? Like in a bear market, that will always be the case. It's going to be better off for you to buy Bitcoin than their stock. But you could say the same thing for if you look back at every single, like the bull market following 2020, you would have been better off buying a strategy than you would have been buying Bitcoin in Bitcoin terms. You outperform Bitcoin. Like we don't have, I would say that's probably going to be the same case. Like if Bitcoin bottoms between now and November, and at that point in time, November of 2026, an investor had the option to put $1 million in MSTR or $1 million in Bitcoin, and then you were to basically look at the returns in Bitcoin terms a year or two later, that investor is probably going to outperform in a treasury vehicle because it's gonna trade with more vol. If Bitcoin goes up 10% over that period of time, it's going to go up 15 or 20%.
That is predicated on, and it is possible. Okay, it's predicated on mispricing risk, irrational investment decisions, and hype, which is what happened in 2024. Like I can look at a chart and accept that, and then what happened to the people that paid those premiums? They all underperformed Bitcoin, and they will. That you can't undo.
Because Bitcoin was in a bear market.
No, I don't think that. It's like
everybody that was buying that premium, Bitcoin started to
that's the way that it's sold, but there's not actually a logic to why a stock with leverage that carries more risk that's trading at a premium should be priced at an even larger premium to the underlying asset. It's like, and again, I'm not equating the strategies of the world to altcoins. But like, if you've been around long enough, it's like, hey, people, they released Ethereum, and then Ethereum outperformed Bitcoin. And then over the last 10 years, it's been in the process of trending to zero. And then each next cycle, people are like, oh, alt season's coming, alt season. Like even this past one, they're like, alts outperform Bitcoin in a bull market. And it's like, at a certain point, you have to zoom out and be like, is the market for a single issue stock with leverage that if you were buying into, you'd be subordinated and you're paying a premium to, is the market for that larger than permissionless money? Than the market for permissionless money, which should go up by more? What percentage of the universe would look at, if they looked and understood Bitcoin, would allocate, either all, in terms of like what was allocated to Bitcoin, not all their money, because, people still and do invest. I invest, I own virtually all my savings is in Bitcoin, but I still invest in things to try to, solve problems and produce real capital. But that, what's larger as a market, the market for permissionless money or the market for a stock that holds permissionless money for you?
Well, I would say fiat money is like 150 trillion, equity markets like 150 trillion. So, and then if you look at debt, that's 350 trillion.
Right.
Strategy
but all of that
is trying to go after debt, which is fixed income, which is a 350 trillion market.
But it's not debt, it's preferred equity.
But their convertible bonds were debt.
Yeah, and that's a very small. The convertible market is a very small market relative to the large 300 trillion, and they basically tap that because of a small market. Each participant in the small market has credit concentration limits, and it's again, like I like, just like you said about like, lending banks lending against, or maybe it was one of the other guys is, I think, maybe dropped out, but that if you've talked to people about lending against, Bitcoin mining equipment or lending against Bitcoin itself, that the banks treat it as, zero capital credit. So it's like, at a certain point you zoom out.
That's changing though. That's significantly changing. Like the
no, I'm just saying, but I've talked to
as the accounting rule.
I know, but I'm talking about like how they risk score the capital from an actual bank capital perspective. But even if you look at like the large credit funds that exist in the world, and again, I speak from experience. Like, I haven't been at Unchained for 3.5 years, but before that, I talked to a lot of credit funds. I still talk to a lot of credit investors. The preferred equity, like as a true credit investor, the idea of investing in a security that has no maturity is like, it is a non-starter in most cases. So I have a reason why those products are bad products for the investors. I have a reason for why institutional credit won't and can't buy them. It just very naturally is a fit for retail that's chasing yield. Bitcoin has no yield. So the only yield that can exist is somebody else buying Bitcoin and not you. And even in the context of the preferred equities for the retail investors, in almost all cases, the person would be better off if they just bought a small percentage of Bitcoin. They'd actually have Bitcoin. As they learn about Bitcoin, they allocate some more and some more and some more, and they would end up with more Bitcoin rather than being, left holding the bag when fiat, loses 50% of its value or 100% of its value, or becomes, particularly volatile in hyperinflation. But I'm going to need to run in just a few minutes.
What do you got, Dave? It looks like Dave's raising his hand. He's raised his hand a few times.
Yeah, thanks. No, I'll just add to that. I agree with Parker on a lot of points, but just on the yield thing, what I'm personally expecting is that all treasury companies that remain active will eventually have to deploy their BTC on either Lightning or ARK as a native yield strategy.
That's
currently actually already happening with Block, right? So Block already has like the 10th largest Lightning node. They already reported yield, but they have a proprietary surface with Cash App and now Square with 1 million merchants supporting Lightning. So they have kind of an advantage there, right? And so that would be an interesting play for treasuries to acquire similar surfaces to own like user bases and own that, access layer to Lightning from a payments application, for example, because then you can charge a higher fee for those users that are entering or exiting Lightning, right? But you already have a few treasury companies that are on Lightning that are reporting on like a quarterly or monthly basis, like routing fees, and they're doing quite substantial yield. And if we're expecting Bitcoin to succeed, right, we are also saying that Lightning will succeed because Lightning is growing and there's no signs of its, the growth stopping at all. And with ARK coming up and these types of edge node technologies that allows people to more easily onboard Lightning, you're going to see a massive requirement for liquidity in these networks, right? So both Lightning and ARK servers will need extreme amounts of liquidity.
Yeah.
And the good thing with treasury companies is that they're pooled amounts of Bitcoin, right? So that's the benefit. Like, what could I do as an investor with a treasury company that I wouldn't be able to do myself as an individual pleb? And that is putting capital in a pool that is then deployed on Lightning as an infrastructure, right?
Yeah.
But yeah, that's my 2 cents.
Yeah, I mean, the way I'd say that though is like, no one has communicated a plan around that. That like might be a perfectly good idea, but you're not underwriting that risk when, based on any plan that any Bitcoin treasury company has communicated. And if they did start talking about those things, then people would look at them as less of a pure play, way to, in theory, get more Bitcoin, because then they would be truly putting the capital at risk. So it's kind of like if they started talking about like, well, they were going to start allocating to infrastructure, then you'd start to really have to, you even though they're not today, like people are not pricing these things as if they have equity risk premium, like they're paying a premium to take risk rather than receiving one. But if they were to start to communicate what their plans were to allocate that capital, or if they were at all, then you'd start to have to really price the risk, or be more express. And so it's not to say that people can't invest to make money, but if you were investing in a company with no idea in terms of what they were going to do with the money, just other than you're going to give it to them, like that's not a winning strategy. You just be better off owning Bitcoin.
Can I add something to that? So there's one interesting factor with Lightning, which is obviously the security issue, right? So you're essentially deploying capital on a hot wallet environment forever, right? But what we're seeing is that you will get to a point with Lightning network security and Lightning node security. It's going to be so safe that it makes literally no sense not to deploy, right? So currently, if you run a Lightning node, it's a server. Sorry.
Like either I'm cutting out on my side because you keep cutting out, or I'm cutting out my audio. Something about my feed. I don't know though. I don't know whether it's you or me.
No, it's definitely messed up. I can hear it choppy on mine as well.
This is better now?
Yep, I can hear you.
Yeah, so just a quick one. Lightning will have multi-sig capabilities long term, so you will be able to have a multi-sig Lightning node, which essentially means that you have a multi-signer setup. So you could have one server in one jurisdiction and two other servers in different jurisdictions that co-sign state updates. Very technical, but this is what we'll get to. It's like you take a plane flight. There is a risk of the plane crashing, but it's so safe and there's so much redundancy in play that it makes no sense not to take that flight.
But how does that?
And we're going to get to that level with Lightning. So this is important if you're going to put billions of dollars on a Lightning node, right? You want to have that institution level security, right?
Right, but no Bitcoin treasury company, from what I've seen, has suggested that they're going to do that. So if you were investing in them with the idea that they might do something that they've not said that they're going to do, I don't know how you could underwrite either the risk or the potential upside, because they've not communicated any plans around it. It's just like, yeah, hey, if anybody has any large amount of Bitcoin, they could in theory do that, but you're basically not able to underwrite any sort of risk surface area because that's not a plan they've communicated. It's just like in theory, anything that you could possibly do. Like they could go mine Bitcoin with.
I mean, you already have LKWD in Canada. They've routed 4,000 Bitcoin through their 18 nodes, and you have BHODL in the UK.
I mean, I know that
Block.
I know that institutions are routing Bitcoin, like Square does it, and they make money. I know that there's a way to do that, but the Bitcoin or like Strategy or Strive or and again, I don't know the one that you're talking about, but again, if that was part of someone's plan, then you underwrite the risk associated with it, right? And again, I agree, like routing, Bitcoin transaction on Lightning is about as low risk as you can get. I'm just saying, like the ones that I'm talking about that are the lion's share of the market, they're not talking about what their plans are. So to price it based on this unknown, all you would have to do if you knew that they were going to allocate the capital to a bunch of investments, you would have to ascribe a higher discount rate and further discount because there'd be more risk, maybe more upside, an unknowable amount of risk.
No, I agree. And PSA, I have a white paper coming out on this, so I'll let you guys know when it's out.
Sure. Maybe one more, and then I got to hop and record with Danny from What Bitcoin Did.
You're going on one about strategy?
I think it'll probably come up.
Yeah, well, you're going to be warmed up.
Yeah, got my reps.
Hey, Parker, you mentioned investing in some other products and vehicles outside of Bitcoin. Do you mind touching on that briefly?
Well, like not outside of Bitcoin. I'm just like investing my Bitcoin. So, I'm working on Zaprite. So, that's my time and energy, and I've put my own money into Zaprite, and then I'm also advising on a project that one of my friends in the conventional oil and gas space on the Bitcoin mining side, and I'll likely put some of my own money into that.
Very cool. Yeah, thank you. Appreciate it.
Yeah, appreciate you coming on, Parker. Let's definitely do another space. We didn't even talk. A lot of the other spaces we've done, we somehow migrate to talking about AI stuff.
Yeah, I'd love to talk Bitcoin mining with you guys.
Oh yeah, Bitcoin mining as well.
We can talk AI too, but so maybe we'll do another one and be expressly off of the Bitcoin treasuries to talk about something else for a bit, because I think there's so much going on there.
Yeah, that'd be awesome. We'd love to have you again, Parker.
Okay. Yeah, I appreciate you guys hosting this. Enjoyed the discussion. And again, I enjoy having, discussions with people that share different opinions, and I don't, judge people for, doing whatever they want to do with their money. So, just trying to add to the, knowledge base that's out there.
No, it's a good counterpoint, because you see way too much of like one side bias, especially on X, where it's good to have at least somebody that could present a coherent argument for each side. Yeah, well, I appreciate you guys organizing. Appreciate you guys the good questions and the presenting the other side and challenging my ideas. So appreciate you guys.
Awesome. All right. Well, we'll have to set up another one, but have a good rest of the day, Parker. It was great meeting you.
Yeah, appreciate you guys.
All right. See you guys.
Thanks, guys.